Welcome back. We're talking to Chad Slater, Joint CIO of the Morphic Global Opportunities Fund. Welcome, Chad.
Thanks, Chris.
First of all, tell me how the fund went in July.
July, Chris, was quite a volatile month, particularly at the start due to uncertainty about Greece. But in the end, markets actually finished up 0.8% in US dollar terms, and in Aussie dollar terms up 5.5% due to a strong tailwind of a falling Aussie dollar. Morphic finished up 5.1%, so a good month but slightly behind index.
And how did the fund handle Greece? Because that was the big risk at the start of the month.
All funds have, I'd say, scenarios where they do better in and scenarios where they do worse in. And for us, Greece is a difficult period for us because ultimately it was quite directionless at the start of the month and volatile and went nowhere. So a lot of the hedges that we had on and that we talked about last month ultimately expired worthless. Now, the issue was that Greece had a no vote at the start of the month, which sent markets down. They then proceeded to renege on this and then go along with what the creditors wanted. The markets rallied strongly from this point. So thus far, those hedges we had on expired worthless. The good point was, from the fund perspective, with the hedges, we're able to stay fully invested rather than carry more cash. So net, whilst it was somewhat costly, it was not as costly as what it could have been.
Probably a pretty difficult month all in all with the volatility that Greece was producing.
Oh, it was a tough month to run money in, Chris, and at some period there it felt like it was going to go much lower, and at other stages it felt like it was going to turn around and rip higher.
Just looking at one of the other major problems or risk areas in the market in July, China. Yep. How did you handle China?
When we spoke last month, we described ourselves as cautiously optimistic. We'd been stopped out of a few positions in June, but we still held the view that we thought that markets, particularly the shares that we owned in the H shares in Hong Kong, which were cheaper, would rally. Over the course of the month, the old adage that the only certainty with predictions is that you'll be wrong played out, and markets onshore particularly fell 14% over the course of the month, seeing us stopped out of most of our positions there. So there's really no other way to say it, but we were wrong. The market is measuring the outcome. The good news from our perspective in particular is the process that we just described earlier, so this being July being a testing month, was that the stops actually protected us because those positions we got stopped out of in June were no longer in the portfolio in July. We only carried a small position. So compared to some other funds that may have run fully invested or have increased their positions over that time, we actually came out of it relatively okay.
And what are your views on China now?
We said last month that we were optimistic and we thought things would bottom around here. Clearly, the large amount of intervention that's taken place in the last month brings some real question marks about their inclusion in MSCI. Now, for way of background for the viewers there, the inclusion in MSCI was the Chinese index was going to get added to the global markets for the EM index, and this is going to increase the Chinese weighting. This is actually one of the bull cases for being long China, is that overseas buyers will be forced into buying more. This is clearly off the table for now, and we may even argue that their inclusion in the SDR, special drawing rights, is off the table. So we hold a small position through some options. We think that by Christmas the market will probably be higher, but given we're thus far wrong, we have a much lower and smaller position to reflect this.
And what other areas of the world are you interested in at the moment?
Yeah, probably the most interesting thing in the last month that we hadn't talked about or hadn't thought about is this continuing fall in commodity prices. And in Australia, a lot of people look at the iron ore price, and that's continued to make new lows this year. But what's interesting is the oil price is now back to the lows of where it was. Nickel price is making new lows. So a large number of commodities are pushing into new lows. And this has what we say is three major effects. One, the CPI or inflation will be lower through the rest of the year, which originally people thought would bounce back as we cycled off last year's price falls. Two, it probably means the Fed will have to take this into account when they're going to raise rates because they'll be below their mandated level of CPI. And the third thing is, what if demand is actually falling? Now, we're of the view this was largely a supply side issue, but the falls in prices have been way more rapid than what supply would suggest. So we think there's some real questions going to be raised here about what does this mean for GDP and what does this mean for interest rates later in the year. Our view from here is that this will probably just be another deflationary scare. We had one early in the year, in February, where markets priced in a lot of deflation, commodity prices stopped falling, then rose somewhat, and the market took that deflation risk out. So we think this will be transitory, but we are definitely more concerned than what we were a month ago.
So which markets are going to benefit from this?
Good question. I think last month we mentioned India as an area we're going to look to, and we've expanded on this. We've actually increased our Indian position somewhat over the course of last month. India does really well out of this because it's a net oil importer, so the cost of all of its imports falls. At the same time, if the Fed is not going to raise interest rates, India is a net capital importer as well. So that means there's less pressure on their interest rates, and they're able to cut rates, which is a nice backdrop, particularly for Indian banks. On the other side of the equation, we're not particularly bullish on the US stocks here at the moment. They're going to face the headwind here of higher currency, and you're seeing that in some of the earnings, particularly in the industrial sector. So, as usual, try not to confuse economic outlook with stock outlooks.
Chad, thank you very much indeed. We look forward to speaking to you again next month.
Cheers, thank you.